What is going on, everyone? I got a super exciting lesson for you guys today. I just did a Facebook Live earlier, and I talked about how over the last few days, people who were making pure directional bets in the stock market were really losing a lot of money. And a lot of people who come to the stock market who want to make their first trade, who want to start getting into investments, for whatever reason, whether they want to, have financial freedom, quit their day job, go on vacations, whatever the reason. A lot of people are really going into investments with really improper ideas of how to make money, of how to make trades, of how to make investments. And one of the really cool things that I talk about in the Facebook Live is the people that I work with, the trades that I do, I give myself room to be wrong. So I give myself a cushion, maybe a 5-10% cushion before I actually start losing money, which is really, really powerful. So I wasn't going to do this video right away. This is kind of like my third video on YouTube. I wasn't going to do this video right away, but I wanted to go with it because I think it's really, really exciting. It's really, really cool stuff. So I will show you how to make your first trade, but do it like a pro, like the top 1% of investors do. Now, this video is heavy. It's got some serious stuff. And for the 99% of the people who watch this video, it's going to be a lot different than they ever thought possible, right? The type of strategy we're going to be utilizing that, again, the top 1% of investors use, is not something you ever heard of before. I guarantee it. So what I would recommend is I would watch this video a few times. I would watch this video one time through and just kind of get an understanding of what we're talking about. Don't go try to implement the strategy that we're talking about after the first time. Maybe after the second time or third time, but I guarantee you, if you pay attention, if you watch this video a few times, if you really absorb all the information, it's going to change the way you think about investing. It's going to start your investing career in the right way, and I promise you, you're going to make a lot of money over time if you do this the right way. So again, watch this a few times. Pay attention. It's a little heavy. In the comments below, whatever questions you have, I'm happy to ask. I'm going to make a lot more videos about this. But again, guys, it's going to be a lot different than anything you've ever seen about the market. But this is how the big boys are doing it. So I will see you inside the computer. What is going on, everyone? Thank you so much for tuning into this video. I think it's going to be a really, really fun one. This is just my third video on YouTube, and I wasn't really planning on getting into something like this early on in my, I guess, time on YouTube. But I really had an itch to kind of talk about this because over the last few days, it's been really, really interesting, and this concept really, really applies now almost more than it has at least over the last year or so. And I think it's really, really important. It'll be really, really helpful for everyone to realize exactly what's going on here in the market, in stocks, all that jazz. So I want to talk to people today about the ability, and again, this is what the top 1% investors do. This is what the big boys do. This is what I do. This is what all my market heroes do, is we have the ability to make money in the market when we're not directionally right. And that's really, really powerful. I want that to sink in, and let me repeat that again. So if you have any distractions, if you have Facebook open, Snapchat, text messages, just pay attention to this for a second. Myself, the top 1% of investors, the people that are able to make money year after year, no matter if there's a good economy, bad economy, bull market, bear market, they're able to make money. And one of the reasons they're able to make money is because they're able to be profitable when they don't pick the correct direction. So if they think a stock is going to go higher and it goes lower, they're still able to make money, right? And that's how the big boys are doing it. That's how the pros are doing it. So if you're someone who watching this video now who already has an account, this is definitely something that can be very, very beneficial. You can implement these strategies and this strategy that I'm going to talk about today starting tomorrow. If you don't have a trading account yet, this is going to be an awesome entry trade for you to make, an absolutely awesome one. It's going to give you a ton of confidence to really believe that you can really be very successful in the market, and I know you will. And you guys will be smiling once you see how simple it is, because I'm going to show you exactly how to execute this strategy. But, a lot of people out there, we're talking about how to make your first trade like a pro. Now, a lot of people out there will find a stock they like, they'll buy it, that will be their first trade or investment. But again, the pros, the way I do it, the way the top 1% of investors do it, the way the big boys are doing it, the big boys, they make their trades very, very differently than the average investor does. And I want to introduce you to those concepts. And I'm going to introduce you to one today that is very, very simple, that allows us to make money without being directionally correct. So here's kind of how you normally would do it before watching this video. Here's how you would normally do it, right? So you'd find a stock you like, or find a stock you've heard about from a friend, or something you read online or a newspaper or Jim Cramer or Bloomberg or whatever. And what you would do is you would buy shares of the stock. Right, again, this is your first trade. So you would ultimately, you pick a stock for whatever reason you think it's good. Your kids use it. Friends have talked about it. People have made money from it. And you go ahead and buy shares of the stock. And if you're someone sitting there now that's feeling like this is what you did, or this is what you were planning on doing, or this is what you've done, and because of kind of the speech I gave you at the beginning of this video, you're feeling a little bit overwhelmed, like, oh, that wasn't the right thing, don't worry about it. We're going to cover all of that in this video. Don't worry about it. I'm telling you, everyone else does it. But the good news is you're right here, right now. In the next 5-10 minutes, we're really going to kind of completely turn the investing world upside down in your eyes. The stock market, investing, making money in the market is going to be completely different than you ever thought. And again, in the next 5 or 10 minutes, you're going to know exactly how. So don't be too hard on yourself if you've done that or you're thinking about doing it, because you're not moving forward. And that's the most important thing. You're here. We want you to learn this stuff. We want you guys to take actions. Again, guys, we're talking about how to make your first trade, but we're doing it like a pro, like the top 1% of investors are doing. So again, this is what you would normally do. You pick a stock you like, you buy it. But the reality is, what are the chances you make money from that? If you buy your stock, it could go up a penny or down a penny. So the reality is, it's not much better than a 50-50 shot. Just realistically speaking, logically speaking, would you bet on a coin flip? No, you would definitely not bet on a coin flip. You would definitely not do it. Why? Because the odds are not on your side. It's pretty much a 50-50 bet on a coin flip. That's not very different than buying a stock. If you're very interested in buying a stock like Facebook, while you might think it's going to go to the moon, it's a phenomenal company. Mathematically speaking, statistically speaking, over a large enough sample size, it's really not much greater chance than 50-50 to go up or down. If Facebook is trading at $180 a share, it can only go up a penny to $180.01, or down a penny to $179.99, because that is really not much better than a coin flip. So if you did what you normally would do, picking a stock, buying it, you're really doing yourself a little bit of a disservice, because again, you're making a bet on a 50-50 bet. And then what do you do if you actually make money from it? So let's say Facebook goes higher. Well, what do? Do you hold for the long run because that's what you've heard people say? Do you book your profits after a certain profit target is hit? Well, what do you actually do with that? And I'm sure a lot of people watching this video right now, especially if this is really your first time looking to make a trade, I mean, you're probably pretty overwhelmed with all the different things that have to be considered in your eyes. And then finally, what do you do if the investment or trade goes against you? God forbid. Remember, you're in a 50-50 bet here. So there's a 50% chance that you make money from it, and there's a 50% chance you don't. But just based off there's an 100% chance that you don't really know what to do here. And look, that's totally okay. This is totally, excuse me, this is totally normal. This is totally okay. Again, you're here because you're interested in learning how to make your first trade like a pro, and we're going to deliver that to you. But this is probably 99% of the people who ever watch this video for however long it's on YouTube, and however long I'm teaching this and on this planet, 99% of the people, when they make their first trade, will do it like this. And again, that's why 99% of investors out there don't really make a lot of money, or don't make any money at all. They're not doing it like the pros are doing it. They're not doing like the top 1% of investors are doing it, right? And these are probably some real questions that you have actually asked or felt before going ahead and making your first trade. So, how does something like this sound to you? So like you did before, you find a stock you like, you hear about it from a friend, you read about it online, in a newspaper, in Barron's, on Jim Cramer, on Bloomberg, on Yahoo Finance, whatever it is. Now, if you remember, with buying a stock, you're really not much better than 50-50 to make money. But how does this sound? So you do what you did before, but now you execute a strategy that gives you a 66% chance of making money on the trade or investment. And not even that, but it gives you a 66% chance of making 33% on your money, a 33% return on investment. So whoa. This is a pretty big deal, isn't it? Where before, you had a 50-50 shot to make a dime. In this scenario, you have a 66% chance of making a third on your money, 33% return on your investment. Very, very interesting stuff. And hopefully this is kind of like eye-opening. In the case of just buying stock outright, and let's use the example of Facebook, if Facebook goes up 5%, you made 5% in your money. If Facebook goes down 5%, you've lost 5% in your money, right? So there's a 50-50 shot, not in making the 5%, but there's a 50-50 shot in buying Facebook outright that you will make a penny. However, in this nameless strategy, which of course we're going to get to in the next few minutes, you have a 66% chance of making 33% return on your investment. That's a really, really big deal. That's a really, really big deal. And what's better is you could even do greater than that. And that's what's so exciting about this. So exciting about this. Where am I? Sorry, I kind of lost my thing. Okay, great. So you make 33% return on investment if the stock goes up. Remember, if you buy Facebook, you only make money if the stock goes up. In this case, you make 33% on your investment if the stock goes up, sideways, or anything down less than 5%. So what that means is in this strategy, and again, we're going to get to it in a minute, the stock has to do anything better than going down more than 5%. And if that happens, it can go down 4%. It can go down 4.99%. It can go down 2%. You'll still make 33% return on your investment. Now that is a little bit different, and that should be pretty eye-opening to you guys. So I'm going to repeat it again because it's a very, very big deal. With this strategy that we're going to talk about, you have a 66% chance of making 33% in your investment. Again, in the case of buying Facebook, you will have a 50% chance of making 1 penny. But in this scenario, you have a 66% chance of making 33% on your investment. Not 1 penny, but 33% in your investment. And what's better is you'll still make 33% on your investment if the stock goes down. It just can't go down worse than 5%. That should be pretty eye-opening. So I think you guys are starting to see. I mean, are you starting to see there's a better way? Are you guys starting to see how the big boys are really doing it, how the top 1% of investors? Are you really able to see how consistently over time these top 1%ers are able to make money, whether the market goes up, down, sideways, inside out, bull market, bear market, whatever? Because they are giving themselves room to be wrong. And how much room in this example are these investors or these traders giving themselves to be wrong? Well, in this case, 5%. So you could be wrong by 5% and you'll still make 33% on your money. In the example of Facebook, where again, if you're interested in making your first trade or first investment, you go ahead and buy Facebook and it goes down 5%, you lose 5% of your money. But in this case, if whatever stock you end up doing this in is down 5%, you're still up 33% on your money. 33% ROI. That's some pretty heavy stuff, guys. And don't worry, we're going to get into this all. So let's play this game of would you rather, or which would you rather. Option A is you find a stock you like and you buy shares. Again, don't worry if you've done this or we're planning on doing this. 99% of all investors do it this way. And again, unfortunately, that's why about 99% of all investors lose money. You find a stock you like, you buy the shares. If the stock goes up, you make money, right? If the stock goes down, you lose money. Pretty simple, pretty straightforward. That's how you understood everything happened till you showed up on this video. And the reality is, again, when Facebook's at $1 or $180 a share, it can go up a penny to $180.01, or it can go down a penny to $179.99. Because of that, we don't really have better odds than 50-50, right? And interestingly enough, if we want to make 33% on our money, Facebook has to go up 33%. Makes sense. Or option B, we find a stock we like, just like Facebook, and we utilize a different strategy. Again, I want to harp on this. This is a strategy that the top 1% of investors are using. Remember, they're giving themselves room to be wrong, which is very, very powerful. And utilizing a different strategy that, again, we're going to teach you here in a second. If the stock doesn't go down more than 5%, we make 33% on our investment, and we have a 66% chance of making money, right? So obviously, again, we haven't talked about how to do this trade. We haven't talked about balance sheets. We haven't talked about what the Fed is doing. We haven't talked about geopolitical risks. We haven't talked about charts or indicators. This is really, really important to understand. We haven't talked about any of that stuff. Remember, you showed up on this video that we titled How to Make Your First Trade Like a Pro, and you were probably the 99% of all investors out there, thinking the only thing you could really do is buy a stock. If it goes up, you make money. If it goes down, it doesn't. But now you're kind of unearthed, right? And kind of investing has maybe the way you thought it was happening before maybe confused you, because now you're learning wait a second. I can make a big return on investment, a big return on capital, and I can still be wrong by 5% and get it. That's crazy, right? So again, we haven't talked about the strategy yet. We haven't mentioned balance sheets, research, fundamental analysis, interest rates. We haven't talked about any of that stuff. The stuff that is typically told to people that needs to be weighed in or considered when thinking about an investment, let alone their first one. Remember, we're not into any of that stuff. The options are option A. You buy a stock. If it goes up, you make money. If it goes down, you lose money. You're pretty much at a 50-50 shot. That is one option. Option B is, however, you utilize something else, which we're going to teach you. It is a bullish strategy like buying a stock. However, you can still be wrong by 5%. And instead of making a penny in doing that, you make 33% return on investment. Now, of course, you would rather option B. Of course, you'd rather option B. I don't know why I wrote options A and options B, but it's just option B. That is what we're going to talk about today. And you can see, guys, remember, the big boys, the top 1% of investors, myself and my Market Hero students, we're really only doing strategies. We're only implementing strategies like option B, where again, you don't have to be directionally right to make money. You just have to be smart about it. You have to give yourself a little bit of room for error. You know, it's funny because when I think about how many trades I've made in my career, and I make thousands a year, and I think about the trades where I made a pure directional bet, I'm sure I'd be willing to bet anything that I've been wrong 90% of the time. You know, I'm horrible at that. If I ever tell you to buy a stock, just go ahead and sell it, because I guarantee you I'm going to be wrong. But the reality is I've been able to be really successful over the last few years because I've given myself room to be wrong. And that completely changes the game for me. That gives me a lot of confidence that, hey, you know what? I don't have to be dead right. I don't have to wait for the perfect time because I've given myself a cushion and a margin for error. And that's really, really powerful stuff. That's really, really powerful stuff. So, how do we do it? Well, let's take a look here. We use something called options. Now, there's a lot of information out there about options. Don't worry about that now. Don't worry about it now. We're going to get into it in this video. Options, at its most basic level, they are contracts that are agreements between two parties to buy or sell a certain amount of stock at a later date and time. The reason it's at a later date and time is because all options expire. So where a stock only expires if the shares are no longer listed on any exchange, let's say the company went bankrupt or the company got bought or went private, all options expire at a predetermined date. And when we talk about their agreements to buy or sell a certain amount of stock, every option is worth 100 shares of stock. Without getting too crazy, that's pretty much a crash course on options. You don't really need to know more than that for this video, which would be pretty exciting for you guys. Now, the value in options, right? The only way we can have this concept where we can make 33% return on investment, have a 66% chance of doing that. And again, we can be wrong by 5% and still get that. The only way we can do that is via options. With options, and as you've seen here with option B, with options, we do not have to be 100% directionally correct to make money. And at the same time, we have a much higher return on investment or return on capital potential. And again, you can see that in these two examples. In option B, or example B, we can be wrong by 5% and we'll still make 33% on our money. We have a 66% chance of making money on that. Now, in option A, which is, again, just buying stock outright, the stock has to go up 33% in order for us to make 33% return on our investment. Right? So that's a big difference. Option A is buying stock, just purely buying stock, and option B is utilizing options. So clearly, options give us a nice potential, because it doesn't always work out that way, but they give us a nice potential for a pretty high return on investment. So what is the strategy that we're going to be talking about today? It's called a put spread. So, and don't worry, I'm going to show you all this. I just want to kind of give you the speech ahead of time. But a put spread is where we sell one put. Again, a put is a type of an option that's just an agreement to buy or sell a certain amount of shares of stock at a predetermined date. Right? A put spread is where we sell one put and we buy another put further away from the price of the stock to define our risk on the trade. So let's say we have an $150 stock. In this example, we would sell the $145 put, and in selling that, we get a credit from the buyer, and don't worry about it too much right now. And then we're going to buy a put further away from the price of the stock. So that would be lower. Let's say the 140 put. The value of the put closer to the price of the stock, remember the stock's at 150, so the value of the put at the 145 strike is going to be more expensive than the put that we're buying. Thus, we're selling something and collecting a credit that's more valuable than something we're buying. Thus, we're doing this trade for a credit. And don't worry, I'm going to explain all that here in a second. So now here's how we break it down. We make a full profit, which again is 33% of our money or better. And I'll tell you exactly how to do that. If the stock closes above the price of the put. So in the example we showed where the stock is at 150, if the stock closes above 145, which is the price of the put we sold, we make a full profit. Now remember, we did the trade for a credit, so that will extend our break evens, right? We make a partial we make a partial profit until our break even is surpassed. And don't worry, I'm going to explain this all to you here in a minute. And a max loss if the price of the stock is lower than the put we are long at expiration. All right, so don't worry about that too much. One more thing. We said before how we have a 66% chance of making 33% return on our money. And the way we know that on a put spread specifically is when we take the inverse of the width of the spread and the credit received. So if we have a $5 spread, for example, we sold the 145 put and bought the 140 put, and we collect $1 for doing so, we have an 80% chance of making money, right? So we collect 20% of the width of the strikes. The inverse of that is 80, so we have an 80% chance of making money. If we have a $2 spread and collect $1, right, that's half of the width of the strikes. The inverse of that is also half, so we have a 50% chance of making money. If we have a $3 spread and collect $1, right, that's a third of the width of the strikes, we have a 66% chance of making money because we take the inverse of 33% and we have 66%. So again, guys, just to go over this real quick. Number one, this video is about how to make your first trade like a pro. Pros, the top 1% of investors, they give themselves room to be wrong. They don't have to be directionally right. If the stock goes down a penny, they don't necessarily lose money. That's what 99% of the people out there do, right? They buy stock outright, and it's not much better than a 50-50 chance. However, utilizing options, we have a much greater potential for high return on investment, but at the same time, using options and only options are the only way to give us better than 50-50 chance of making money. And in fact, they can also give us room to be wrong and we still make money. So let's go into my trading platform and see what is going on here. Okay, I use, full disclosure, I'm not getting paid by TD Ameritrade, but this is the Thinkorswim platform that I've been using for well over a decade to do all my trades. I would never use any other trading platform ever. To me, this is the only trading platform out there that was created by actual traders with the sense of this would be for actual traders. So again, this is the only platform that I have ever used and I will ever use. However, TD Ameritrade is not sponsoring this and not paying me any money from this. It's just a really good platform. So I'm going to go to a company called Snapchat. So Snapchat is probably a company that everyone's heard of. Medium, that's fine. Probably a company that's everyone's heard of. If you have children, they're probably on Snapchat. If you have friends, they're probably on Snapchat. You could send each other photos that go away or are deleted after you send them. So it's kind of a cool app, and yeah, that's all I got to say about that. So here we're looking at an options chain. On the right, we have calls, and on the left, we have puts, right? So don't worry too much about what all these numbers mean. I just want you to, I really want you to walk away from this video thinking that there is a better way, right? If you watch this video a few times, you'll be able to execute this trade and be able to make money from it. But I want you, the first time you watch this video, I want you to be able to walk away from this video just knowing that there's a better way and feeling like if you haven't made any investments yet and you're a little timid to do so, that you absolutely can, while at the same time, if you were thinking about getting out of your investments, that you stay in the game. So what we're interested in doing, again, is finding a trade that gives us a better than 50% chance of making money and also gives us a little bit of room to be right. Now, we talked about this concept of a put spread. And a put spread is selling one put. So what's going to happen is I'm going to go to the put side, and I'm going to go to the 14 put, and I'm going to click on the bid. That will sell me the 14 put. So a put spread is selling one put and then purchasing a put further away from the price of the stock or lower to define our risk. So what I'm going to do is I'm going to buy the 11 put. And the way I'm going to do that on this platform, I'm on a Mac, is I'm going to hold down the control key and I'm going to go to the 11 put and I'm going to click on the ask. So actually this worked out a million times better than I could ever have imagined. This is perfect for the example that we talked about right now. So I want you guys to kind of pay attention right here. I want to make this a little bit bigger, down here. So what we're seeing is, first of all, we sold the 14 put and bought the 11 put. The price of the 14 put is about 139, and the price of excuse me, the 11 put is about 39. So we're selling something for $1.39. We're buying something for 39. We still have $1 left over. That's the credit we have received. So if we were to execute this trade, we would be receiving $1 in credit. So we would profit on this trade the full dollar if Snapchat stayed above 14 in the next 101 days. That is what we're talking about here. Snapchat is currently trading for $14.94. That's the last price. $14.94. 5% below $14.94 is $14. So actually, this is so cool. This is literally the perfect example. I'm pretty pumped about this. This is literally the perfect example. Where are we? This is literally the perfect example. Again, if the stock doesn't go down greater than 5%, that's what we're looking at Snapchat here, right? Because we make money if the stock is over 14. So if Snapchat doesn't go down 5%, if it goes down any less than 5%, or it goes up, or it goes nowhere, we will make the full dollar, which is the credit we received. Now that is so amazing, because again, this is only a $3 wide spread. We only have to put up $300 for this trade. We collect $1, so our max profit is $100. Our max loss is $300. So that's a 33% return on our investment. And now this is where it gets really interesting, guys and girls. This is where it gets really interesting. When we sell a put spread like this for a credit, it widens out our break even. So while we get the full $1 or 33% of our initial investment, if the stock doesn't go below 14, we will still be profitable until the stock goes below 13. Now let me show you here. The break even for the stock is 13. And the reason for that is because when we do a trade for a credit, we get the money. They give us the money. And we can put that really in theory to this trade here. So where originally the stock has to stay, so while the stock has to stay above 14 to make the full maximum profit, which is $100 here, which again is 33% return on our investment, we don't lose money until the stock goes below 13. So again, while Snapchat can go down 5% or less in the next 100 days, if we make a full 33% in our money, Snapchat has to go down even more for us to lose money. So what I'm going to do is I'm going to try to figure out how far down Snapchat needs to actually go in order for us to lose money. So let's see, 11.9. Great. Snapchat has to go down more than 11.9% in the next 100 days for us to lose a dime on this trade. Now remember when we were talking about with Facebook. If Facebook goes down 11.9%, you lose 11.9% on your money. However, in this scenario, if Snapchat does not go down, if Snapchat goes down 11.9%, you're only just starting to lose any money at that point. And that's what makes it so powerful. So again, Snapchat can go down 5% and you still make all of your money on this. You still make 33% return on your money. And if Snapchat goes down even more, you don't start losing money, right? Yeah, you don't make the 33% return on your money unless Snapchat stays above 14. But if Snapchat stays above 13, right, then you're still making some money, which is so amazing. That's why it's so powerful, guys. So again, I just want you guys to really understand. So I want you guys to really just understand what we have talked about here. I want you guys to watch this video a few times. This is some really powerful stuff. And on this channel, let me guys know if you want me to kind of go into more stuff or vet this stuff more or have more videos about this. But this is some really powerful stuff. So again, most people showed up here. Most people showed up here on this video interested in making their first trade or investment. And I think that's amazing. Hats off to you. I hope it can help you make a lot of money. And they were like option A. They find a stock they like and they buy the shares. Now, they buy it. If it goes up a penny, they make money. If it goes down a penny, they lose money. Ultimately, that's really not much better than a 50-50 bet. But what we talked about is what those top 1% of investors are doing, what the big boys are doing. You know, the people that are really able to make money every single day, month after month, year after year. What they're doing is they're utilizing a strategy like a put spread like we talked about here. And that put spread specifically allowed us to make 33% on our money in any scenario unless the stock went down more than 5%. And specifically, we wouldn't start losing money on the investment or on the trade until Snapchat or this stock was down more than 11.9%. So that's the difference. That's really kind of the baby maker. That's really the big one. That's how the top 1% of investors are able to make money all the time. And I hopefully watch this video a few times because it's super powerful. Watch this video a few times. Hopefully you can go ahead and do them too. But I actually want to go through this one more time to explain it to you guys because it's super powerful. Okay, again, what is a put spread? A put spread is selling one put and buying a put further down to define the risk. So if we sold the 14 put outright, we would have risk all the way down to, we would have a full, the max loss would be the stock going to zero. However, when we define our risk by buying a put further down, our max loss is more defined. In this case, the max loss is only $200. So we have defined our risk there. And what we're doing is we're selling a put that's more valuable than the put that we're buying. So again, the price of the 14 put is $1.39. The price of the 11 put that we're buying is 39 cents. You take $1.39, subtract 39 cents from it, you're still left with $1 that you've received in credit. So now we are not making money if the stock goes up a penny, and we're not losing money if the stock goes down a penny. What we're doing is we're giving ourselves 5% to be wrong to still make 33% on our money, because remember, we have to put up $300 to make this trade, and our max profit is $100, right? Max profit is $100. So we've given ourselves 5%, picking the direction incorrectly by 5% to make 33% on our money, right? That's obviously a far cry from we lose money if the stock goes down a penny. Further, because we're doing this trade for a credit, we have increased our break even. So our break even is now down at 13. So we don't start to lose money on this trade until the stock goes down more than 11.9%. So that's really a major difference here. Again, we've given ourselves 5% to be wrong. If we're wrong by 5% or better, we make 33% on our money, and we don't start losing money on the trade until it gets worse than 11.9%. And again, the way you figure out what your chances are of making money on a put spread like this is the credit you received. You take the credit you received and subtract it from the width of the strikes. In this case, it's a 3, right? And then you take the inverse. So we've collected 33% of the width of the strikes. So our chances of making money are 66% chance. So again, buying Facebook outright. If Facebook goes up 1 penny, you make money. If Facebook goes down 1 penny, you make money. In order for you to make 33% on your Facebook position, Facebook has to go up 33%. But now we go over to Snapchat and we're talking about a put spread. So we do this trade, we collect $1 in credit. The reason we collect $1 in credit is because the put we're selling is more expensive than the put we're buying, thus we do it for a credit. In this scenario, we collected 1/3 of the width of the strikes, and the inverse of that is 66%. So we have a 66% chance of making 33% on our investment. If we are wrong, because this is a bullish strategy, we want the stock to go up, right? We want the stock to be above 14 or 13. If we are wrong by 5%, we still make 33% on our money. And we don't start losing money on the trade until we're wrong by more than 11.9%. So again, guys, that's the difference. I recommend watch this video a few times. It's super, super powerful. I hope it helped. Hit me up in the comments if you guys have any questions, you want to learn anything. But again, guys, this is how it's done. This is how you make your first trade like a pro.